Okay, hello and welcome everyone to today's session. And again, my name is Mohammed Shanti. I'm a research and financial market analyst at FXPesa. I will be your presenter today, and today's session will be about how to manage your gold portfolio. I know a lot of people trade this precious metal, and so many people attend to follow their news, and it's a very important item for investors, especially for short-term investors and long-term investors, because it is one of the products that you can actually make it in the forex market, but still it could be dangerous if not handled very well. So in this, just to make sure that you guys can hear me, just to make sure, just to confirm, guys, can you please send me in the chat that you can hear me and you can see me clearly? Please send in the chat. Right, just to fix it. Okay. Okay, just to make sure, can you guys hear me now? Okay, great. Okay, where were we? Okay, we were talking about gold and the importance of gold for investors in general, as whether they were short-term investors, speculators, or even long-term investors who actually buy and hold. They do the buy and hold strategy, waiting for long-term profits. Today we will cover as much as possible from gold, and also we will give you a risk management approach towards gold and how you can actually manage your portfolio based on risk management rules. And also we will give you a trading setup where you can actually use a bunch of technical indicators where you can use it to decide whether to enter the market or and exit also, and also to decide is it a good time to enter this market or not. So starting with the slides over here, first of all, why do investors care about gold? Gold is used as an investment for many reasons, taking advantage of market price differences with the continuous rise in prices over time. So this is one point. Another point is that it covers the risk of inflation and decrease in the purchasing power of cash. It covers the risks of economic and political tension. Gold is part of the portfolio risk coverage, and it reduces the risks of fluctuating currency exchange rates, the most important of which is the US dollar. So basically, gold is known as the safe haven, a safe haven item where you can actually use it to trade. Okay, you can use it to manage your risks with other already taken positions, whether you trading currencies, indices. Gold can actually manage that by actually taking a really long position before, and whenever you see a small, let's say a small dent in your balance, you can actually close that trade to cover the losses that happen from any trades that you've already experiencing. So it's one way to look at it. Another way is that you can actually trade it whenever there is a fear factor in the market, whenever there are some expectations that everything is not doing well in terms of uncertainty. So people and traders tend to go to gold, seek gold in order to cover their purchasing power ability. So it's really important item, and I think everyone should be following this precious metal, especially its news and its main fundamentals. So talking about the fundamentals, so gold for consumers. So it has long known that a lot of people, a lot of traders use gold in the industry. It's not just only used in trading purposes. It's actually used for physical other industries, other related items. So it's basically inside the industry, medicines, and jewelry. So the jewelry industry, as you can see from the chart over here, gold actually being used in electronics in 73% part. The main part of using the gold is basically 73% of it to electronics. Another part is for luxury item, jewelry, and the way to a lot of people actually tend to seek this jewels because they love to show off, or they actually see it as a luxury way to express themselves, and so on. Another thing, it's an official coin to be used 8% and as a currency, and 5% of the way we use it is for other materials such as medicine and treatment. We have also used it for aircraft industries, glass, building, industrial, and automotive industries use gold heavily. So gold is used in many sectors around the world, and also it's being used to be traded and to speculate. Now, remember, guys, since we are dealing with gold as a commodity, the prices of the gold actually it's actually been affected by what? By two main things. First of all, demand and supply. So it's really important to know what is the demand side and what is the supply side. So this is regarding for consumers. Now we need to talk about who are the producing countries who actually mine this precious metal. So we have in this table, you can see at this graph, you can see China, Russia, Australia, and United States are the four major producing countries in 2019. This is really important to know because you need to have a really long-term view whether how much production is happening in gold. So is there any supply? Is the supply number are really good? Is there demand in general? So once you know that the numbers, for instance, in China going lower, you would know that there is something happening. That means they are actually dropping their inventory. They're losing their, for instance, they're selling their inventory. That means they're actually increasing the supply over time. That means prices could go lower, buying more of the precious metal, which means there is demand and therefore prices could go up. So it's important to have a really a big picture about where are the top countries, where are they in terms of demand and supply. So you can see the China produced about 338 tons, followed by Russia, which is 329, and then Australia, which produced 325 tons. So it's really important to know the supply side over here. So the supply side, it's you can know the more supply they are producing, the less the price will fall. The more the price will fall, and the lower the production happens, therefore the supply will go lower, and therefore prices could go up depending on the demand. Now, another point is our gold prices significantly affected by production. Now, it seems that in the last decade, as you can see, prices has been going lower and lower in terms of production, in terms of its effect on the effect of production on gold prices. Look at the production. Basically, it's been stable over the past decade. However, prices been moving out from upward, downwards, and then going up again in 2020, reaching the $20.74 per ounce. So basically, the prices in the long term has not been affected heavily by the production, because the production were stable. Okay, but rather it tells us that the demand side is really important. So it's important to know where is the demand coming from, and how can we actually use that kind of information in our trades in the future. So there's no doubt that production news may slightly affect prices in the short term due to the impact of that news on the trends of the traders. But in the long term, the relationship between the movement of gold prices and production of gold appears to be minimal for the time being in the past decade. Now, countries with the most gold consumption, who actually use gold, who actually they are actually the countries that decide the demand. So look at India, China, and the US. You can see there are 136 tons from India alone, and also from China, which tells us that both these countries buy a lot of tons of gold, which could indicate that these countries, they use it to hedge their whatever risk they are facing. So remember, guys, we are talking about a perfect, not perfect, let's say, but still one of the most used item to cover your risks. So basically, once you know that the Central Bank of India, for instance, actually buy a lot tons of gold, so that means they could have a future expectations about the demand, or actual about the supply in general, or about the inflation, or about a lot of stuff. So basically, it's important to keep tabs on these countries, even though the news of knowing that these for instance, central banks um, decided to buy, for instance, and you would know about this news maybe later on a month. Still, it's really important to know about them, even though they are a bit lagged, but still, it would give you a really good indication in the long term. Why do we need the view of the long term? Because once you know that there is a bearish pressure to the downside, let's say for gold prices, you would know that whenever there is a rise in gold prices, this could be an opportunity to sell it. Similar whenever you see a bullish uptrend, a bullish long-term view, okay, whenever there is a dip in gold prices, you could actually see it as a buying opportunity. So in terms of short term or even long term. So these kind of news regarding central banks owning a certain amount of, let's say, tons on gold would give us a really good indication what's going to happen. So if they increase their consumption in the future, that means prices could be in the long term rise, and that's what's happening lately. Now, are gold prices affected by demand? Now, we've noticed that the demand for gold is divided into several types. So the demand for jewelry, technologies, industries, and demand for central banks. So it seems that the demand from the central banks, as you can see, the central bank net purchases, actually it's the main affecting, let's say, player who actually affect gold prices. So the demand from the central bank is considered to have a slight effect on the price of gold, and the demand for gold for the consumption, such as jewelry and technology industry, affect the prices, but only slightly and not significantly. So what else actually affect what are the main attributes that actually push the demand in gold prices? Investments. So whenever you see a lot of hedge funds buying ETFs, for instance, linked to gold, that means they are actually increasing their demand. So they use the gold basically for what? To hedge their risks. So they use it to minimize the risks that they are being surrounded with, and now they trade the long term, for instance, to mitigate their losses. So what are the main drivers for gold prices? So from the chart, we notice that the investment demand has very large impact on gold prices. The investment section, as you can see, this is the investment section with the light purple over here. And also, why do they use it? So why do investors use it? So they use it as a haven from economic and political circumstances or situations or geopolitical tensions, a haven from high inflation, and an investment in the market. So it's a good investment in general. Whenever anyone actually owning, let's say, a coin of gold, physical gold, is really good for the future, because prices might actually, you can use it to actually cover your wealth in any term. So whenever, and gold is always required. It's not gonna stop being demanded in the future. So it's really important. I really apologize about that. So it's really important to know these demand and supply side, because it will give us a really good picture. Now let's talk about what influence gold prices. So who are the players that actually affect gold prices? So we have central banks. A limited effect, because the change in reverse is little compared to other variables. So the dollar exchange rate and its value. So since we are actually dealing with gold, but not dealing it against itself, no, we are dealing it against another currency, a certain currency, which is the dollar. So we have the XAU and the US dollar. So when you trade XAU USD, you're trading gold against the dollar. Yeah. Now, if you look at it, the supply side for the dollar, is always there. So the dollar will never end. So basically, the demand side is the one that affects the dollar side. On the other side, you have the gold, which is affected by both supply and demand. So it's really important to understand the relationship between these two, and therefore I would actually act or decide my investment depending on the information that I get from either the supply and demand for gold and the demand side from US dollar. So I need to follow also the dollar news. So the impact of the dollar is significant on the movement of gold prices. Sorry about that. The impact of the dollar is significant on the movement of gold prices. Just to make sure, guys, can you hear me again? Because my headset just turned off. Just to make sure that you guys can see me again and see me clearly. All right. Okay. Where were we? Okay. So as I said, central banks, the dollar, and now the global consumer demand and global industrial demand. Medium impact on gold. It's a medium, not very high, but still medium. Gold production and production costs slightly affecting gold prices. So what do I mean by the cost of producing it? Producing it, it will actually affect if it was very little, let's say, supply over there. But there is supply, and therefore there is competition. The competition makes prices, the cost, a bit lower. So basically, it's slightly affect gold prices. Now, investment demand, investments in general, as a safe haven use, it's the most influential factor in price of gold. Okay, in terms of prices. So what other factors that we care about from central banks and for the investment, for us as an investors? One of the things that everyone should follow is interest rate decisions. So interest rate decisions, lower interest rate decisions boost gold prices. Historically, whenever there is a drop in interest rates globally from all over the world, you would see gold prices tend to go up. If you go back to the 1973, you would see prices, whenever there is a drop in interest rate, gold prices tend to go higher. So there is a reverse relationship between interest rates and gold. Another thing is that inflation numbers, if the interest rates are going lower, okay, or they are actually low levels, you would know that inflation, whenever it goes up, you will see a lot of traders seek gold to cover the risks of inflation. That's why you are seeing lately, I will show it to you on the MT4, on the trading platform. You'll see prices moved from the 17. This actually, after the coronavirus huge surge that happened with gold, you would see there's let's say, relatively a small retracement on the weekly charts. You would see a small retracement for gold prices. So it went down from 274 to 1692, or even a bit lower, but now it's retraced back again to the upside, and now it's reaching the levels of 1800. So the reason why it actually rose that way, because inflationary pressure, okay, or expectation of higher inflation in the future, okay, could make investors a bit afraid of high inflation, and therefore they are seeking gold. So inflation, interest rates are really important figures. Now, just to continue with the slides, we have also, when do investors start seeking gold? So expectation of future and low inflation, actually inflation in general. So it's negative with the movement of gold prices. Whenever there is low inflation, usually it goes lower, and so on. Expectation of interest rates in central banks, especially the US Federal Reserve, an inverse relationship. Bond returns, as you know, lately the US Treasuries are actually going higher a little bit, ticking higher, and it's indirectly affecting gold prices. How? Because it's actually pushing dollar demand. Higher dollar demand means higher US dollar, the DXY, the index. Therefore, since it's gold against the dollar, whenever the dollar goes up, you will see the commodity linked dollar will go down, and therefore, whenever bond returns go higher, dollar goes up, and therefore gold prices go down. And inversely, the same thing happened whenever bond yields go lower, and that what happened during the coronavirus pandemic. During that area in 2020, you'd see the bond prices actually going lower. So if bond yields are actually not paying me, if I'm purchasing, for instance, bonds and they are not paying me yields, why would I seek bonds while they are not giving me any return, but rather go to gold, even though they are not giving me any yields, but still they are much better than bonds that which are at very low rates. So traders seek gold whenever their bond yields start going lower. And and vice versa. So also the confidence in the market. So as I told you before, uncertainty and also fear factor affect the market confidence. So because it affects expectations and therefore prices gets affected. So whenever there is a confidence in the market, usually is bad for gold. But in fact, rising confidence increases the position of risky stocks and assets. So the more you see traders seek, let's say the more shares, they need an item to hedge or to mitigate the certain losses, if for a potential losses. Therefore, they actually bound to go for gold also. So, but with let's say with a little bit of lower, let's say lower a bit of lower, let's say sizes, let's say. Okay, so basically, even during uncertainty, the amount of gold that you buy is much higher. However, whenever there is confidence, the amount of gold you will buy is a little bit lower than compared to the fear factor, or where there is no confidence in the market. But still, it's going to be there because it will hedge and will play as a risk reduction for any portfolio against it. So stages also of the economic cycle. So gold is negatively affected by strong growth expectation, but when approaching an economic boom, okay, the demand for gold increases due to inflation, and that's what's happening at the moment. Many economists believe that we are at a certain peak or at a certain boom, okay, in terms of the economic cycle, the global economic cycle. So when there is a huge, when we are in that part of the economic cycle, prices of gold tend to go higher because of inflation fears, and this is what's happening at the moment. Now there is inflationary pressure, but at the moment, at the current situation, inflation numbers are still low compared to the central bank's targets, but still they are actually rising with every month, and this is what's causing traders to be afraid and making a lot of pressure on actually making the an inflationary pressure on central banks, and therefore there could be a change of certain policies. So the monetary policy at the moment, low interest rates, increasing the purchasing assets program, and currently, if we hear any change of tone of actually hiking interest rates or making it higher compared to the current low interest rates, this could actually affect gold prices. So at the moment, low interest rates, higher expectation of inflation, pushing gold prices higher. So so to continue, the beginning of the recession also increases the demand for gold, but with the arrival of the economy to a recession. So the demand for gold decreases because the recession reduced the desire to invest. And that's what's happening. Usually at the start of any recession, people or traders tend to get out of the market, even from gold, because they want to hold as much as possible cash. Okay. Once they know that their purchasing power of cash, whenever they bought before, is actually now lesser, they drop the dollar and then go to gold back again. So it depends on the timing of the economic cycle. By the way, for any question regarding any question, I will answer all the questions regarding for the fundamentals and even technicals later on at the end of the session. So we will have 10 minutes just before the end of this webinar, and we will continue the we will answer every question related. Okay. Now, what are the main variables that affects gold prices? Demand on ETF. We have also the US dollar exchange rate, the occurrence of very large movement in currencies, especially the currencies of emerging countries. We have also demand and supply resulting from consumption and industry, and we have also central banks' demand for gold and or reduced possession. So also we have expectations of future interest rate and monetary policies. We have also the alternative opportunities to gold, such as bond and equity market investments. So whatever happening in the bond market actually affect gold prices, and also the economic activity and growth. So these things are important from the fundamental side. You can actually know these data through the economic calendar. You can actually go to the website You can go to the website, our website, fxpesa.com, and then actually go to the economic calendar and seek information. You will see information related to the US dollar. You will see information related to let's say data, economic coming events related to the, for instance, for the franc. You will see economic events related to gold, and so and hence you can use that to trade, and based on what's gonna happen or what are the expectations, you can actually make your position later on. So why do you need to start investing in gold now? So this is a question that everyone should be asking himself, in terms of, if I was a trader. So do I need to start investing in gold or not? So this is a question by itself. And if so, why? So preserving the purchasing power of cash. This is one of the reasons. A safe haven from economic uncertainty, and to speculate against the prices. So as I said, inflation currently is below the 2%. Once it reaches this target, maybe in 2024 for the US, maybe we'll start seeing a hike in interest rate, and therefore you could see a drop in gold prices. So I would know from that date, maybe in the long term, I will see prices will go down $300 or $400, okay, per lot, per ounce. So I need to know every time there is let's say an opportunity, I would actually take a short position, okay, and hence the same situation happens in the exact opposite situation, where low interest rates, higher inflation expectations, I would actually look for long-term buying and hold positions. So these kinds of information are really important. Now, speaking away from before starting talking about the risk approach, or the risk management approach for gold, and how to manage your gold portfolio, and even the trading strategy, will give you a small it's really important to know that before investing in gold, you must define your goals for this investment and what risk you can take in it. So you need to know exactly, I need to know what is my balance, what are my risks in general. I need to know how much money I can afford to lose in general if I took this trade, and how much I might lose. So I need to know beforehand, before even trading in gold, what is my general risk. Okay, so because it's really important to know your risk reward ratio, and once you know it, you can actually know exactly how much lot sizes I'm going to take, how much let's say the volume on the MT4, and how much where's my stop loss going to be. Also, I need to know where's my take profit. I need to understand what is my risk and reward ratio. So need to understand now, am I a speculator? Am I a long-term trader? Am I intermediate trader? I need to decide what kind of investor I am. Am I actually risk taker or not? These kind of questions you need to decide before even investing any dollar in gold. It's really important. So, and also you need to know the time period to invest. So are you daily trader? Are you long-term trader? These kind of questions are really important. Now, decide, will gold be your only portfolio investment? Am I gonna use it only as a trading purposes only for gold? Am I gonna add to it another currencies? I'm gonna buy bonds. Am I gonna buy, let's say, indices and so on? These kind of questions are important. You need to decide them. Am I going to put a different account where I can trade gold only, and then I use another account? Why? Because it's important to know that if let's assume that I have two accounts. If I have one account here with $1,000 and another account with $1,000, and I'm trading here only gold, and the other account I'm trading actually currencies, what is my risk? Is it the 2,000, or is it 1,000 here and 1,000 here? And the first thing a lot of traders think is that because I'm trading only gold here, so my risk is only $1,000. That's really a wrong assumption. My total risk is the $2,000 that I'm trading, even though that I'm trading separate accounts. So I need to understand these kind of questions. Do I need to have gold with me or not? Do I need to have gold with the same account or not? This you need to decide. The best person to ask, actually, the sales guys. They can actually help you with this kind of situation. It doesn't, there's not a lot of difference to have two accounts or one account, but still it's really good to know, because you might want to handle gold in a separate account, because you are actually focusing on gold alone in that account, just to know exactly what's going on. But that's your preference, and we will continue now. there are some certain rules. Now, this is for the note takers. Okay. Um, so just before we go for the risk management tools and so on and the rules, there's a question there that says, what is the best website or news for gold related news? Now, there are different websites. Basically, as a trader, as a currency trader, and also I would look only for instance, for the economic calendar. Now, you can actually dig deeper and nerd about it. You will find a lot of other good source of news. Now, it's important to know how am I going to use this news? Am I gonna skip the news and trade after the news happen, or even before? That's something that you need to decide. Now, understanding the fundamentals first is more important than knowing where these news are coming from. Okay, because sometimes I would know about a certain news, but prices don't go along the way because the expectations were not met. So it's really you need to know if I'm a short trader or long-term trader first. So talking about gold portfolio and the rules, there are certain rules in terms of risk and also for the take profit, and then we'll go to the technical analysis part. Now, rule number one: you need to decide your risk per position. You need to know how much balance you have and what is my risk per trade. So the risk on the financial position is related to the type of trading you perform, whether it is in the long term or intraday and or even short-term analysis. Depend if you are a short-term, long-term analyst guy, and then you want to trade depending on that. If you are a short-term speculator, calculate the total risk that you can bear on the gold portfolio in general. Let's assume that we have $10,000 balance, okay, to trade in gold. Then you must determine the percentage of the total risk that you want to risk. Is it 5%? Is it 10%? Is it 20%? This number differs between traders. So for instance, I would use 2%. Some other guy use 1%. Another trader would use 20%. It depends on your risk appetite. Remember that the risk you place here will be reflected on your potential profits. So the more risk you take, the more returns. The lower the risk, the lower the returns. So let's assume that you want to take a risk of 50% of $10,000. Yeah. So the total amount of risk is $5,000. So I'm actually using 50%, $5,000 of the 10,000 that I have. The second step is to determine the number of financial positions. I need to know how many positions I'm going to make in the, let's say, in a month. I need to decide how much or how many trades I'm going to make. So it's really important to know, because each time for instance, I know that, for instance, I trade gold in a month, let's say 100 trades. So if my total risk is $5,000, divide that by 100, you will get $50 a trade. For instance, I need to lose 100 trades in order to lose all my $5,000. Okay. Now, if the 50 financial, let's assume I'm gonna trade let's say 50 positions, not 100. Okay, if my 50 financial positions are decided, the partial risk, which is the risk per trade, which is the risk for one financial positions, will be equal to the total risk divided by the 50 by the number, and the result will be $100 for each trade. So each time I know that this trade, my maximum loss is going to be 100. I need to know how much lot or contracts, because we're dealing with with gold CFDs. I need to know how much contracts should I put in order to have 100 loss if it happened. If let's assume, like, if my stop loss got hit, I need my stop loss to be exactly $100, and I need to repeat that 100 times. So I need to lose 100 times or 50 times, depending on how many numbers of trades you want to take. If I lose all these trades, I'm going to lose my total risks that I decided. Okay, so that's the second step, let's say, for rule number one. Now, in the event that you decided to be a trader on a medium or long-term time system, here the number of proposed financial positions should be reduced. So rather than using 50 trades or 100, you would actually go for 10, depending on you as a trader. Now, using the same rule and for the same example before, where the risk is 50% of your 10,000 portfolio, then the risk will be for one financial position will be 10,000 divided by 10, which is the number of financial position, meaning risk per trade will be 1,000. Now, once we decide how much if let's say if my trade went sour against me, I will lose only $100. That's important. That's really a key. Now, the second rule: determine the potential profits on each financial position. Now, once I decided how much I'm going to lose, I need to know how much I'm going to win. So basically, if I'm willing to risk $100, for instance, per trade, I'm not going to just accept $100. I'm not going to risk $100 to gain 100. I'd rather actually take more. Now, what is the least accepted, let's say, for professional traders, the least accepted ratio that I would actually afford to take it, or actually it's worth my time to take it? This is where the golden ratio comes from. The 1.618 multiplied by the risk value, which is, let's say, for $100, I'm willing to if I'm willing to lose $100, I'm willing to win $161.8. Okay, so my ratio is 1 to 1.618. So why this ratio is important? Because this ratio will enable the trader to achieve a return if he succeeds in more than 20 financial positions out of the 50. So let's assume I lost 30 trades. Okay, 30 trades. For each trade, I'm gonna lose 100. So that's $3,000. Okay. Now, if I'm winning 20 positions and my take profit got hit, I'm gonna win how much? 3,263. So my net profit gonna be what? 263. So this is a ratio that I use in the long term. In the long term, statistically, it's not possible to lose all your 50 trades. Okay, if you take, let's say, one lot, two trades, 3, 4, 5, 6, 7, 8. At a certain point, you must win a certain trade. Statistically, it's hard for you to lose all your trades. Now, let's assume that you lose 30 and you win 20. You will get a net profit. If you lose, let's say, if you lose 31 trades and won 19 trades, here's the net profit is gonna be almost the same. So I'm not gonna either lose or win. So imagine if your win rate moved from, this is by the way 40% win rate. Imagine if my win rate increased from 40% to 50%. This number will change and my net profit will change. So in the long term, I would know beforehand that I'm gonna win, even if I don't know anything about technical analysis. Let's assume that I'm using a coin toss to trade 50%, 50%, but the price is gonna go up or down. At a certain point, either the take profit or stop loss is gonna hit one of them. So I'm gonna repeat that, let's say 50 times. I need to win 20 times to make profit. Now, this is with the assumption that I don't know anything about technical analysis. I don't know anything about fundamentals. Imagine adding fundamental knowledge and also technical analysis to decide the best, let's say, to decide to improve the win-loss ratio from 40% to 50%, or even to 60%, and rather also 70%. This will make sure that this ratio will make sure that you're gonna have a net profit in the end. Okay, so this is really important. If you have any question about it, I will show it to you later at the end of the session. Now, this is the second rule. Okay, now the third rule: determine the number of contracts. Now, this is where the tricky part comes in. For a lot of traders, they don't know what kind of contract that I should take. They assume that if I put one lot, my stop loss was, let's say, $70, and another trader see it's $60. They assume that they have the same risk. No, they are not, because they are using the same lot size, but however their stop loss is different. So basically, one of them gonna lose more. So you need to know exactly how much. For instance, how much. Let's say I have $20. I assume that my stop loss is gonna be somewhere below $20 below the price. Okay, I need to know where is my stop loss gonna be. Okay. So after that, you need to decide how much contracts I actually have. Okay, so $20. So if it moved $20, this $20 must equal 100. If it moved against me, I need to calculate that. So the number of contracts appropriate for the financial position is calculated based on the specified stop loss. So you need to decide, you need to decide where's your stop loss based on the rules, and then divide that amount, divide it by dividing the amount of risk. Let's say, what is the risk, $100, by the number of stop loss points or pips. multiplied by the pip value. So we know for instance, one contract means for each $1 movement, that's $100. Okay, so for mini contract 0.1, for each for each $1 movement in gold prices, a 0.1 contract will give me how much? Will give me $10. If I have a micro lot size, so 0.01, so for each $1, it's gonna give me $1. So based on that, I know what is my pip value. So what's next? So suppose that you have analyzed the goal technically or fundamentally, doesn't matter, or obtained a financial position from any party. Okay, for instance, that you got something from the smart report, the one that we send every day to our clients. Okay, so the equity group, which is the FXPesa group, which is part of the equity group, and we send it daily on a daily basis. So let's assume that you have a buy gold situation, buy gold at, let's say, 1750, with the expectation of a target of 1800 and a stop of 1720. So basically I have a $30 a $30 stop loss, and I have a $50 take profit. So assuming that the pip price on gold is $10, okay, then the calculation of the number of contract will be as follows. So the number of contract is 100, which is the risk. This is important. 100 divided by what? By the 200 pips, which are my risk, okay, times 10. So 100 divided by 2000 will give me the number of contracts. So again, the risk on the financial position, 100 divided by the 200, this is wrong, this should be 1730. So 200, which are the 200 pips, divided by what? By divided by 10 equals 100 divided by 2000. In our case, if it was 1720, it will be 300 times 10, 100 divided by 3000, and therefore you will see a lower number. This is how you decide your lot size. So first of all, what is my risk? Second, I need to know where's my what is my risk reward ratio. Third, I need to know what's my lot size. Now let's go for the fourth rule. Okay, for the fourth, before we go to the fourth rule, so what do we expect from the three laws of for managing the gold wallet? The risk in most cases will be limited. You will know exactly how much risk you are actually taking by knowing exactly this is my stop loss, this is my lot size. Basically, if I lost, I know I'm gonna lose this much. That's it. Now, if you make a return on 40% or more of the attempts that you make, so basically 40% win rate, you will likely to make net profit using the 1.618 ratio. This is a strategy for managing a gold portfolio, can be adjusted to match the risk and return by increasing or decreasing the risk on the deposit account. So the more balance I put, if I have 2% in general, let's say 2% per lot, per trade, if I have more balance, my risk automatically will rise. Therefore, my lot size will increase. If I have a lower balance, let's say 2%, also will mean I will have a lower risk in general. Therefore, my lot size is gonna decrease. So it depends on your balance and depends on your risk, the number of risk that the percentage that you want to take. So these are the rules. Sorry, I didn't include the fourth rule. The fourth rule, it is the technical analysis. So the fourth rule depends on the strategy itself. I need to know if my technical setup is competent with my risk reward ratio. So let's say I have a technical setup. It says buy, and let's say it gives me a really bad stop loss, somewhere really far. Then my number of lots is below the micro, so it's not gonna happen because the MT4 not gonna take something lower than 0.01, because my stop loss based on the technical setup is giving me somewhere really far or somewhere it's not applicable. So it's really important to know. That's the fourth point. It's really the fourth rule depends really on the strategy itself. So let me share with you my let me share with you my MT4. Just quickly, this is a naked chart, by the way. Can you see the chart? Just to make sure that everyone you can see the chart. All right. By the way, for we will have a Q&A time. Don't worry about it, and we will continue. Now, just before going to the question and the question and answer section, we have a naked chart. So, what is the technical setup? Basically, first of all, I need to add what? I need to add a moving average. That's the first rule of thumb. Moving average. This strategy works for the 1 hour, 4 hour, and for the daily time frames. We need to have a moving average, some exponential moving. Okay, with a closing price and apply. Basically, a really fast moving average. We need another moving average, but a bit slower. So we need to increase the periods to 50. Okay, we'll have another color. Let's say the blue. So what's the point of these two? It's very simple. We use it for crossover to confirm continuation. We use it to see if prices close above it or not. So whenever prices close above the two lines, bullish. Whenever prices go below it, bearish. Okay. Whenever there is a crossover, a confirmation. Confirmation to either to the downside, like here, or like here, a confirmation to the upside. Okay. Now, the main important indicator that we're gonna use is going to be the Parabolic Sar. Okay. As it is, save the same settings. Basically, it's really easy. Let me change the colors to make it really easy for you guys to see it. It's a very simple indicator, but really helpful for gold. Let's make it bluish or a bit pinkish. Okay. So it's very simple. Whenever the dots move from lower, let's say if it was below the prices, whatever they move above the prices, that's a signal to entry. So here, exactly here, this is a signal to enter the market, and you sell here. This is what my profits, my stop loss is going to be somewhere here. Yeah. And also whenever it's go below the prices, that's an entry signal. Okay. So you can use it as a combination together as what? For the moving average, whenever prices close below it, that's a signal for me to sell, but I need confirmation. I need prices, the Parabolic Sar to move above the prices. So here, exactly. So let's assume here where the prices actually close, but the Parabolic Sar still not telling me to sell, but rather told me here. So at this moment, that's a sell. Here was also at this moment here, there was actually a setup, and therefore you can do it for every time. Now, just to have more confirmation, we need to have another indicator, which is the stochastic. Remember, since it is a demand and supply heavily affected commodity, so we need to have an indicator that tells us overbought or oversold. Overbought, that means what? Overbought, it means that there is a huge there was too much demand, and now the demand will go lower, and there was a huge supply, for instance, or demand, sorry, low demand in general, and now it's going to increase. So whenever there is a crossover between the two lines, that's an indication to exit the market. Whenever the prices go below it, that's also could be an indication that this might be a good entry once the prices go above it again. So I would wait for prices to go here above the two lines, above the 18 line, and then wait for it to go lower. This is an indication for sell. And whenever it goes lower, we need to wait for it. Whenever it goes up, it means it could be an indication. Now add this together, all the three rules together, you would have a really good technical setup. So for instance, here prices are below. Sorry, the Parabolic Sar is above prices. Prices are below moving average. Okay, one moving average, and there was a crossover to the downside. Now it actually got out at this candle. So here I'm gonna enter. My stop loss is always above, for selling, above a resistance line or a previous high. This is for the sell side. Okay, now for the buy side, my stop loss is gonna be where? For the buy side, below a support line or below an a previous low. Okay, this is one way to look at it. Okay, now if you saw, let's say this was my entry. If calculating the difference, let's say from 1775 and 17, let's say 90. That's $15. So $15, that's my stop loss. So this is my stop loss somewhere here, $15, and this is my take, and this is my entry. Yeah, let's assume. Okay. Now this is a huge stop loss. So this could be not really good, but rather the system told me here. This is one of the fourth rule. Whenever the system gives you somewhere really far away, it's not really appropriate for my risk reward ratios. Though, so therefore I'm not gonna take it. So I need to have my technical setup uh, complete my technical analysis, complete my system. So the technical analysis with my risk profile, they should be together. Okay. So when they are saying, for instance, my technical setup tells me to go short or long, and my risk reward ratio doesn't fit, I'm not going to take my trade. And even though I know the price is going to go up, even for a slight chance, for instance, still that's a FOMO trade. So that's the fear of missing out a trade. So basically, I would rather actually not take it and be safe in the long term. Okay, because sometimes the FOMO trades could actually damage your trades in the long run. And we are here in the basically forex traders basically they aim for the short term, sorry, for the long run profits. So they want to trade now. Maybe in 6 months they will have a really good profits. Okay, so if I want to play the short term, I might get some money at the start, but maybe because I'm actually trading a lot of FOMO trades, maybe it's gonna actually damage my account later on. Okay, and you will see a lot of losses. So basically, it's important to have to complete your technical setup with the rules. Okay, so this is it for today's session. If you guys have any question about how to use the indicators, about these fundamentals, the supply and demand side, inflation in general, and so on. Any kind of information, please ask. I'm not sure if this is a question or not. This is suitable strategy for trading gold. Basically, if this is a suitable strategy, from my side, I think it's really one of the best. Okay, it's really important to have the baseline, confirmation one, confirmation two together. They need to align together in order to have a really good trade. So whenever you see a range trading, one of the indicators must tell you that you shouldn't enter it. Okay, that's one way to look at it. Is there any question or any other question, guys?
Shanti, there was a question: how and what are the sources for demand and supply for gold?
The resources. Resource for the demand and supply.
Yes.
As I told you, the economic calendar, you can actually use FXPesa, but you can actually use another source, which is, let me just double check. Just let me give you the source itself. So you have a website called Kitco. Okay, KITCO. Okay, search it, Google it. You will find it's a really good source for news, gold news. Also, you can actually use the economic calendar. So, for instance, let me show you. For instance, another website for the economic calendar. You can use Kitco. Okay, Kitco really good. Okay, and you can use the calendar, but rather, let me show you here. Okay, this is the economic calendar for today, but this is for currencies. I need to find, which is called Forex Factory. You can actually use the metals calendar. So you would know on a daily basis what's affecting gold prices. So basically we have copper inventories, unemployment rate, and it gives you the impact. So the higher the impact, the higher of volatility that's going to happen once the event released or the number released. Also, you can follow up with the website called Kitco to follow up with news. Also, you can actually use our terminal, the research channel, to find any really latest news about gold in general. You can actually go to the client portal. Also, you can go to the if you have a fund account, you can actually go to the client portal. We can actually find news about the Dow Jones 20 news. So basically, all these kind of information you can take from this website and actually base your trades on it. Okay. Let me see. Is there any other question? Collins. Is there any other questions from Facebook followers?
Just a moment.
By the way, guys, these indicators are available to your charts already. Whenever you download MVT4 from our client portal, you can actually find it through insert, indicators, and then go to either the oscillators or to the trends. You can see the parabolic side is at the trend section and the oscillators for the stochastic oscillator, okay? And you can use it to trade, okay? And you can actually play with the settings to make it a bit more clearer, play with the colors to make it much more easier for you to read. Now, the way we use the Parabolic Sar, it's very simple. Above the price means bearish. Below the price, whenever it changes from above to below, that's bullish signal. And a close above moving average, that's a better confirmation. And there a crossover to the upside, also another confirmation from the stochastic. So all these three together would give you really good indication what's going to happen. So let me show you what happened lately with gold in the 4-hour chart. So here at this moment, prices at 15th of April at the 5 a.m. actually closed above. So that's the first signal. And it gave me before that prices, the parabolic sar went below it. That's another signal. So we have here, for the time being, bullish, yeah? Now, at this moment exactly, the stochastic gave me to enter. Now, this is my entry, and this is my stop loss gonna be. My stop loss below previous low, and then my take profit. Where's my take profit? So if this is my stop loss, let's assume, so this is my entry. So this is 1740. My stop loss is 1718, $22. 22 times 1.618. So $20 times 1.618. That's my target's gonna be times times $20. So my take profit is gonna be somewhere $32. So I need to push. So this is my entry. I need to add to the 1742 $32. So if you add to it 1742, you will get my take profit is gonna be where the 1774. So my stop loss, my entry, and my take profit is gonna be somewhere here. So 1774. This is based on the ratio. And now notice that the prices actually went up, and got hit. This is one trade. So this one trade, one complete trade, that's a win. Okay, repeat that 100 times. Repeat that every 100 times. You need to have, or 50 times. If you have 50 times, you need to win 20 times to make net profit in general. Okay. All right. So let's have. There's another question here. And what to apply? Sorry. And what TF to apply strategy? Kindly. What time frame? Sorry. Yeah. What time frame? The time frame here is the best use are the 4 hours, 1 hour, and 1 day. Okay. If you want to go lower, I would actually use another moving average. Another moving average, a bit between these two. So for instance, we have the 50 and we have the 20. I would have another 30. This would give me an indication of what's gonna happen, and I would actually use the stochastic, but not as much as the 1 hour or 4 hour or daily. Okay, so I would use the 3 moving averages with the Parabolic Sar. I would actually consult the stochastic in general, but I would actually not depend 100% on it. Okay, because it's already lower time frames. Lower time frames, the best indicators are the moving averages. The higher time frame, you can actually use stochastic and you can go further. Okay, that's one way to look at it. Okay.
No other questions.
Okay. Sorry. There's another question. Can you illustrate a trade with all 3 indicators? So as explained before at the 1 hour chart. So for instance, here, let's go for the 1 daily chart. Okay, for long-term traders. Okay, so whenever there is a crossover here to the upside or to the downside, that's a signal. Whenever the prices are below moving average, that's also a signal. Whenever the prices are above it, that close above it. Closing, that means I need to wait the daily candle to close above the daily candle, the signal. So for instance, here lately here, you can see there's a double bottom also formation. You can actually use classical formations to have a really better view. So I know this is a bullish setup. So I need bullish setup might happen. So I need a confirmation. So basically this is my support area. This is almost my resistance area. I need prices to breach it, but I need more confirmation if there is a false breakout or not. So here's the indicators comes into hand. So look at here, exactly at this candle. At this candle here, it told us it closed above the red line. Okay, so that's a signal. Now, at the same time, it entered the 80 mark. Now, this is a signal, but another counter signal. So basically, that's not an entry point. So I'd rather wait. So here also closed below it, and there is a crossover to the downside. But still, Parabolic Sar is showing us bullish. So this is not an entry also. Now, if you go to this candle over here, there was a crossover to the top side, close above, and bullish Parabolic Sar. So that was an entry. Okay, that was an entry. Now, this is on the daily chart. Imagine. So as you can see, from 1761, that was a bit for the daily candle, that a bit a bit too late, because prices actually were in the 1733 and so on. But still, there was a signals from before. So experienced traders actually would take these trades, but with lower risk. And once the prices go above, they take another position, like scaling in. Okay, scaling in with the full risk exposure. So they would have actually two trades. One of them is actually making money. The other one would make money in the future. This is in the long-term view. If you look at it at the 4-hour charts, here exactly it gave us a signal, a cross signal. Now, if you can see, my stop loss is gonna be here, yeah, somewhere here. Sorry, I'm gonna remove these red lines again. Okay. So let's look at the latest signal from the Parabolic Sar. The Parabolic Sar for the bullish, that was the last bullish signal, this candle. Now here was my entry. My stop loss is gonna be somewhere below here. Okay, my take profit, multiply the difference by 1.618. That's my take profit somewhere here. It's gonna be, let's assume. Now, look at there was a crossover, closing above Parabolic Sar. That's a signal to enter. Now, it went down, a small retracement, but then it continued. Okay, now it's best used, the moving averages. Another feature you can use is this crossover over here. Now, in the long term, in the 4-hour chart, you can see there was a crossover here, but the start of the bullish movement what happened here. So here there was a confirmation to the upside, but still Stochastic not with me. Now the Stochastic told me to re-enter somewhere here, exactly here. Okay, exactly almost the same price. So at this moment, it's already above moving averages. Parabolic Sar bullish, Stochastic confirmed. Take the trade. Okay, so that's how many pips? That's 2,000 pips. Actually, $20. $20 if you use one lot, that's $2,000. Okay. Another way, if you look at this small retracement over here, cross over to the downside, closing below. Parabolic Sar actually gave me bearish view. It went down all the way, almost $16. Okay, that's another, could be a really good, could be a good setup, but still small profit. Another indication here, change of view, entry here, exactly here, at this candle or this candle, closed above, entry. Now look at the Parabolic Sar now, close below, but there is a crossover. Close below, close above. Parabolic Sar gave me a reversal. Since it's above moving averages, I cannot take this trade because they are not all together. I hope this illustrates every question. Is there any other questions? Okay, the question section. Okay. All right. Thank you guys so much for your questions and for keeping up with us. Uh, please join us for our next webinars. We will talk about a lot of new stuff that you would find it very handy. Please follow us on our Twitter. We have also on our Facebook and the Instagram and social in all our social media channels. Stay updated and follow us. And I want to say thank you so much for your listening and for staying with us. Thank you so much, guys.